The difficult economic times in Kenya was sparked off by mostly dry weather in parts of the country and political unrest experienced in the Middle East and parts of the North African region, otherwise referred to as the MENA region. The result has been very high pump prices due to increased crude oil prices on the world market that has had a knock-on effect on the prices of basic commodities like foodstuffs. The shilling has considerably weakened and inflationary pressure is on an upward surge, currently at about 14.95%.
The level of inflation for the lower income group is about 16%, and the upper income group is about 10%.
Growth fundamentals this year have not been in support of a positive outlook, such as the high interest rates and an unstable exchange rate. Consequently, the equity market in the short term, businesses may have to cope with high interest rates on their fixed incomes. But in the medium term, say early next year, growth fundamentals will look up.
Performance of the stock market, we're actually down about 10%. Although quarter two we recovered a little bit, we got about 2.1% on the NSE 20 and we got about 1.5% on the PineBridge index.
We are likely to see inflation come down again at some stage in the future, and we think probably inflation will peak round about the end of this year, and inflation will start coming down the beginning of next year as food supply becomes more readily available following the harvest.
Looking at the proportion of expenditure on food, housing and transport, the lower income group consists of about 70%. Hence, any rise of inflation affects the group more, meaning the more the inflation rises, the higher the number of people pushed below the poverty line. Zawadi Mdibo, KTN Business Today.